Welcome to the Seattle Investors Club podcast with Julie Clark and Joe Bauer, where we share the nuts and bolts of real estate investing from our 20-plus years in the industry. Sit back, relax, listen, and immediately take action. Are you ready? Here we go.
Welcome to the Nuts and Bolts of Real Estate Investing podcast. My name is Joe Bauer, and I'm here with my co-host, Julie Clark. Julie, how you doing today?
I am doing spectacular, Joe, but I've noticed one thing.
What?
You didn't give me the adjective or anything before you said your co-host. Usually you would say lovely or
spectacular.
Something. Yeah, I mean, I had to call myself spectacular. I don't think that carries as much weight as when you call me spectacular, right?
All right, let me try again.
Okay, let's do it over.
Welcome to the Nuts and Bolts of Real Estate Investing podcast. My name is Joe Bauer, and I'm here with my absolutely amazing, spectacular co-host, Julie Clark. How was that?
That was perfect. And now I feel absolutely amazingly spectacular. So thank you for that.
Fantastic.
Us girls, we need a little, I don't want to use, I'm trying to find the right word, but you guys all know what I'm talking about, So thank you, brother.
Oh, yeah.
What's up? What are you in, Mesa?
I'm in Mesa, and I have some news for people. Oh. We saw our first rattlesnake yesterday.
Ooh.
Yep. We were charging down the trail. Fortunately, we had Emily's uncle with us, and he was leading the path, and he saw the snake first and
he's the one that caught it.
Yeah. He took one for the team, but he's still here. It's okay.
What happened? Did you have to get a stick and do some crazy stuff to get scared away, or?
So that's what his plan was. He was looking for a stick to kind of brush it off of the trail, but the snake ended up just slithering away on its own. So nothing too crazy, but the rattlesnake, it gave us a couple rattles, but it wasn't actually as loud as I was expecting. I'm expecting, all right, if we're trail running down and a snake gets scared, we'll hear a pretty loud rattle. No, very soft.
So you just happened to, did you guys stop because you heard the rattle or you saw the snake?
So we saw the snake and kind of jumped back and then,
Yikes.
Waited. Yeah.
Okay. Well, that just gives me another mama thing to worry about when I rock myself to sleep at night, worrying about you getting eaten by bears and all kinds of stuff that I worry about on my young man here, Joe Bauer. Well, all right. Good stuff. Well, I'm glad that you're safe. So, but I heard you love Mesa.
It's just a great place this time of year. Weather is, 75 to 80 degrees. It's dry heat. The flowers are starting to bloom in the desert, and desert flowers are very pretty.
I don't know why I think I hear people love Mesa. I got to give you a little side note there that my dad, Mr. Ed Clark, for those of you that know that character, is actually in Mesa right now. It is him and his ladies 55 and older mobile home community that they love to visit every spring or at the end of every winter. So if you need a dip in the pool and a nice game of cards with a bunch of talented and interesting elderly people, I'll give you his address. You can stop by and say hello.
Yeah. It's a great place. I think he's got it figured out.
Yeah, he keeps telling us to come down there. Maybe we should do that. Anyway, yeah. Well, right on. I'm trying to find an awesome way to introduce our awesome and spectacularly spectacular. We got to give him the same welcome, right?
Yeah.
Guest today, Mr. Brad Smotherman, who is an investor and coach and all-around stud out of the Nashville, Tennessee market, is with us today, guys. Brad, what's going on?
Julie, I'm just
Welcome.
blushing over here with that kind of an intro. So we're doing well, man. I really appreciate you guys having me on.
Awesome stuff, man. I appreciate you being with us. So a little bit about Brad, guys. Brad is, he has a podcast called Investor Creator, if you want to check that out. He also has a blog called The Roadmap to Financial Freedom, and I'll call it select, kind of like select soccer team, coaching program called Investor Creator Blueprint. And we're going to talk about that more as we roll through this thing. But first of all, most importantly, let's get to know Brad a little bit better. You know that here at the Nuts and Bolts of Real Estate Investing, we're always looking for people that identify with our crowd, guys, who we are, the type of people that we like to be, which is straightforward, honest investors. We're the play by the rules, nicey nice crowd here at Seattle Investors Club. So I imagine a lot of you listening feel the same way I do about engaging with people that have the same mindset. And to the best of my ability, I believe Mr. Brad has the same mindset that we do. So I'm just going to read this off his website, because what's your website called, Brad? Is it just bradsmotherman.com?
That's correct.
You guys need to check this out. This guy has the smoothest website. I'm super impressed by his flow. So I'm just going to grab something off there as a quick intro so we can jump into this here. So Brad's passion is being a top house flipper in the nation. Yep, he's a big boy, does some big stuff. And helping other newer investors build a sustainable real estate investing company. His focus is on buying single-family flips creatively, both subject to and with owner financing, and selling retail or with owner financing, like creative wrap notes and stuff like that. And he is dedicated to helping others do the same and have the same success. Just a genuinely great guy with a lot of experience, and going to give us some deep dive details on how he runs his show today. What I like about Brad's style, guys, is he keeps it simple and straightforward. He gets to the point, and I think we're going to find out today that he's a good communicator, which makes our lives easier and more exciting to listen to guys that can give us a wealth of their knowledge like that. So let's do it. Let's jump into it here with Brad. I just want to say, I like what you said, Brad, on your website. It simply says, I'm Brad, and I want to tell you the truth about what it takes to succeed as a real estate investor. I don't know why that just caught my attention, because it's so simple and straightforward. Everybody has all crazy websites, that they don't even know what they're about.
We don't have time to fudge. So it's like, let's get to it. Let's tell the truth. There's much misinformation that I can see in the market. And I'm really not the guy that says like, oh yeah, flip houses from your bathroom. Don't ever talk to a buyer or a seller and spend $0. Like, I just don't think that's real.
Right. I also like this thing that you said. I see that you said here, there's one thing that I've done that has given me a quantum leap to success. I found great mentors. There's nothing that is going to make you successful faster than copying what the successful do. How straightforward and true is that, guys? Right? So
it was certainly successful or true for me. I had great mentors starting out. David Alexander, based out of Dallas, was my first mentor, and still a great friend. We talked this morning, and he's doing amazing things. So it's really important to surround yourself with good people.
Awesome sauce. Well, let's jump into it and get to know you better. So Joe, kick us off, brother.
Yeah, Brad. So the first question that I always ask is about getting to know you a little bit more. So I like to jump back in time and hear kind of where you grew up, how you grew up, and how you got involved with these mentors or even like influential people earlier on in your life that took you down the path of where you are today.
Yeah. So kind of as a nutshell, I was raised by my grandparents from the time I was 18 months old, and I was always kind of older. So like my childhood hero is Andy Rooney off of 60 Minutes. Like he's the guy that did the outro every time. And I don't know that. I know that's kind of odd, but we were in farming and agriculture. So we raised beef cattle. We had a farm of corn and soybean, and there's nothing wrong with farming. I mean, there's some of the best people I've ever known, but I realized pretty early on that I didn't want to be a farmer. So in high school, I was pushing carts at the local grocery store, and I was 17 years old, and one day I just woke up one morning and said, I'm going to get my real estate license. Well, my grandfather passed away when I was 14, and my math teacher in 8th grade, he was a good mentor for me. He was a strong, positive role model for me, and he was a real estate agent. Well, I found out the next year that he had retired from teaching with a master's degree to go and sell real estate, and I thought that was kind of odd because it seemed like a step backwards. But I reached out to him, and he remembered me, and he said, yeah, you should do this. Get your real estate license. I got licensed when I was 18. My first 6 months, I made a total of $1,800 in revenue. Now, I don't care how you budget. $1,800 across 6 months does not work regardless of age. But I had a builder developer pick me up, and I learned new construction and development I began selling new construction, pre-sale homes, and had a lot of fun with that until the crash happened. And what I saw with the crash was that real estate agents that were making, $200,000, $300,000, $400,000 a year during the boom were going back and cold calling. And I realized I didn't want to do that. So I was like, well, let me learn about cash flow. Let me learn about rentals. And I ended up finding David Alexander through a real estate forum back before flipping homes. And this kind of ages me on the real estate spectrum. But there was, before Bigger Pockets, there was flippinghomes.com. And they had a forum, and David was in there. And he would say these cryptic things like never buy unless you sell. And he would talk about cash flow and notes and all these things. And it was just amazing to me because I messaged him with a question. I'd never bought a house before in my life. And he was like, well, just call me. Here's my cell phone number. And I couldn't believe it because this guy was like a saint to me, and he was just a great guy, and he ended up mentoring me. And so I retired my license in 2010 just to do investment, and we've been rock and rolling ever since.
Awesome. I love it. That's good stuff. It's funny how we keep running into guests on our podcast that got started in like high school, started having their interest in high school. It's kind of been a theme lately, don't you think, Joe?
Totally. I'd never heard that before, but it's cool.
All of a sudden there's like 3 or 4 people in a row that are like, yeah, in high school I decided, and I'm like, what the heck? I was like drinking like Old English and I was doing back in high school. Curious though, so you gave up your real estate license. I am a big fan of investors having their real estate license. So why did you give it up? Why don't you still have it? Or maybe your wife has one, or somebody on your team has one. Or what's your decision on to have it or not to have it?
Sure. And that's a great question. It was really 2 things. So number one, at least in Tennessee, and I know a lot of this stuff is state specific, but in Tennessee, you have to have full disclosure on any marketing if you're a licensee. So if I had a We Buy Houses sign out, or if I did a piece of direct mail, then I would have to have my broker's info and phone number. Well, I tried to do that, but what I found was that a lot of the calls were going to the broker instead of going to me. And so that was strike one. And strike two was, I think it was the day that I retired my real estate license that I made it as an investor. Because what I did was I burned the ships, burned the bridges, and I took my entire income stream and said, well, I'm going to be an investor, or I'm going to be on my deathbed asking the doctor if he has a house that he needs to sell. And so I found that it was really difficult for me to go to a house and say, well, I can list it for this, or I can buy it for this. I got listings, but I never bought anything. But it was the day that I retired that license that I really made the commitment to be an investor, and it worked out well.
I understand that mentality for sure. Out, problem is out here in our market, here in the Northwest. I don't know about where you are, but boy, it's it's expensive, and it's expensive to market. And there's so many people, if you're spending money on marketing, my theory has always been, well, you better be able to capitalize on whatever you're spending your money on for your lead generation. And if you only have one way to do that, it can, I feel like you're leaving a lot of money on the table. But you are correct. I think it absolutely also depends on the type of investor, or, let's say wholesaler or buyer that you are, that there are certain parameters that work to be both a broker and investor and wear both hats, which is my specialty, which I teach people. But there's definitely some lanes that are where it doesn't fit. But either way, I appreciate your, part of what you said was, well, it just allowed me to zero in on focus on 100% of what I wanted to spend my time and what I wanted to be, which was an investor, right?
Yeah, so 100%. So there's certainly positives to being licensed. I mean, having MLS access is huge. And like you said, being able to capitalize on lead flow, whether it's to buy a house or to sell a house as a licensee, is super huge. And but for me, I know that was the right decision. I know that a lot of people, they have their license and that works for them. So that's a great thing.
Yes, definitely individual by individual case, but good stuff. So which markets are you investing in now?
So I have bought in 16 states. My hub is still Middle and East Tennessee. So, I mean, that's where the majority of my deals are. But, I mean, we have deals in Alabama, Georgia, Michigan, Pittsburgh, Pennsylvania right now, Little Rock, Arkansas. So we're kind of all over.
Is that lead flow on those deals coming through your coaching students, or is that you do actually marketing or some sort of marketing in those markets?
Yeah, so we're marketing nationally right now. So I think we're in 126 markets or so.
Nice.
Right now for our lead gen. So we're kind of all over.
So how does that work? What's your team structure look like?
Yeah, so I've got a full-time acquisition person. I have a half-time disposition person, a full-time project manager, which manages the construction and what we do here. And he has a few employees himself. So, I mean, I guess by technicality, they're mine. Let's see here, a few VAs, that kind of, but we're pretty lean.
That's, I think, lean and mean. That's the way to go, right?
That's us.
So is like half your business a certain type of, do you specialize in certain deals? I know well, maybe we should back it up and before we talk about the type of calls and deals that you do, maybe talk a little bit more about, your lead generation machine. I hear it's something special. I looked at the, what was it called? What was that other guy's name? I'm trying to think of where I stole some of the information I have today. House Flipping HQ.
Okay.
You were on a podcast at some point on that, and they said that it said that you had some crazy lead generation machine, like some actual machine. What is that all about?
Yeah. So at one point we were doing so much direct mail that we bought a printer to do it all in house. So it would print 4,300 letters an hour and fold the envelope, stuff the envelope, or fold the letter, stuff the envelope, and stamp the envelope. So we were able to have 4,300 mail-ready letters per hour made. It's actually been a while since I've done any direct mail. So one thing that I've found in this industry is you'll have like some who moved my cheese moments. So when I started marketing, it was all bandit signs, and it got to where the market had recovered from 2010 to 2013. So it got to where the effectiveness kind of dissipated. So I went to direct mail, and then it got to where we were mailing at one point like almost 70,000 letters a month across different markets, and it just got to be too much. And then I went online, and I think that that's still the best way to go. Although I find that it's not as effective as it used to be. So we're all the time kind of testing new things. We're about to start some ringless voicemail and see how that works and all that. But at one point we were just doing mail, and that's the machine that was referring to.
Right on. So when you say online, are you like doing like AdWords, or are you doing Facebook marketing, or all the above, or?
Sure. So for acquisition, we're all AdWords. So everything that we're doing is AdWords. And the reason that we went really wide as far as 126 markets is a few reasons, but and I don't really know how much of this you want to get into, but I'll just kind of like throw it out there, and then it's like people use what they want. So we went to 126 markets because we could go for really motivation type keywords. So something like "sell my house today" is a much more motivated term than "sell my house" or how to list a house, something like that. So we're going really wide with the net, but we're only looking for motivated type keywords. And so with that, our lead cost goes down because we're able to bid less per keyword when it comes to Google's algorithm. And I don't manage that. I barely understand how it works, but I have a really good guy that does. And so he does that part. But all that to say, we're able to lead gen in markets for motivated terms. And our lead flow is not like really crazy, but it's really, really good quality motivated leads.
Right. Quality over quantity.
100%.
What are you having to spend? I mean, what do you think? Do you have any idea what somebody who doesn't want to go to 126 markets, but maybe when you say 126 markets, I imagine that means sub-markets, some of those being in the same state?
Yeah, sure. So that's going to be 126 metros. The biggest 126 metros outside of a few areas that the median price range was just too high for us to really play with. And so it would be those metros and then maybe a 40-mile radius around them.
What's your median price range you're going for?
It really depends. And so we have somewhat of an algorithm to kind of like yes to this market, no to that market. Part of it's based on appreciations that's happened in the market. So, but for me, I really don't feel like Beverly Hills is the market that I want to play in.
Right.
It's probably not the highest motivated. And even though it may have tons of equity, I don't know what the median value would be there, but I'm sure it's outside of our wheelhouse.
So what type of budget are you looking at for that kind of ad spend? I mean, obviously lots of people don't need to be in, especially newer investors don't need to be in 126, metros or whatever. But what do you think for somebody that wants to just stay in their own area? Do you have any idea of like, could that be like you're spending $2,000 a month on that? Or what kind of, is there any way to give us a ballpark on what that might look like to give people hope that they might be able to start smaller?
Yeah, absolutely. Whenever I started, I literally started with one box of real estate We Buy Houses signs. And so, because I couldn't afford anything else. And at that time I had retired my license. And so I had an accounting degree, an undergraduate degree in accounting. I went into tax for a short time and I realized like, I just do not have the personality type for that. Went back.
That is my exact story. Same.
Oh, really? That's wild.
Didn't like it. The personality thing, it was not for me, and went in real estate.
Yeah, 100%. So, I mean, one thing that I'll say is, you start where you are, but to talk about budget, it's really market dependent. And so you have some markets that are just really just pushover markets as far as acquisition. But since we're always caught in the buy and the sell, we don't really care about what the market looks like in terms of whether it's a buyer's market or a seller's market. So, for instance, to give an example, you have Pittsburgh, which is like a real easy pushover market when it comes to buying houses, but they're more difficult to sell because it's a market that the population is decreasing. So you're like in the middle of the Rust Belt. You're not going to have appreciation on houses in many cases, but it's like a really easy cash flow market. We take that versus DFW, Dallas Fort Worth market, which was a pretty tough market for us to buy in. And it's one of the few markets where mail overall actually worked better than internet. But we were still able to go in there and make money, but it was tougher because you have Open Door, you had New Western, you had like these big conglomerates that you had to compete with. So, all that to say, I really think it's important to look at the ROI. So your marketing should absolutely 15x. And I say like 10x to get you through the learning curve. But if you're not making $15 for every dollar in marketing, then you've got a real problem. Like something's broken. And again, that's after the learning curve. So you know your scripts, you know how to negotiate, you can spot a deal, you can deal structure, and all of that each one of those is a very wide and very deep knowledge base. So learning how to negotiate isn't innate, right? Like we're not born negotiators. Some people think they are, but when it comes down to it, you're really not. You may be a good talker, you may be good to build a rapport with people, but overall we have to learn these things. So if you're astute and you're good at what you do, your marketing should 15x 100%.
There you go, guys. There's your benchmark. If any of you listening today are at 15x, I can think of one person, maybe two people that I know right now. Off the top of my head, that might be. But if you are, hit me up at julie@clinvestorsclub.com so we can put you on the podcast, or at least talk to you about how we can get you some more deals also. But that's awesome. That is awesome feedback. So I'm curious. So the RVM, right? The ringless voicemail stuff seems to be, the thing that's blowing up right now. All the gurus are talking. Sean Terry's got his RVM machine and all that stuff. Do you know who Sean Terry is?
I do.
Yeah, I actually like Sean Terry. I think definitely his whole guru machine has exploded there, but. Do you think, how come you haven't done that yet? You haven't needed to?
Well, it's been that. And I have a good friend of mine, Luke in Des Moines, Iowa, who's done really well with it. I just didn't know much about it. And I didn't know if it was legal. I didn't know like really what the circumstances were with it. I know some states or some of the attorney generals are talking about it in a negative fashion. So I think it has a shelf life for sure, but I do think it's probably the new direct mail.
Right. For the moment.
Yes.
For the moment. That's right. I agree with you. And my pause on it has also been the legal aspect to it. Right. I know that you can, let's go back to this. What kind of lists do you have? Like list criteria do you go for? I mean, when you get big like you, when you're mailing that much mail, do you find at all that you sort of, if you get too specific on your criteria, I know you're looking for super motivated, but do you have a problem of, well, you're in so many markets, maybe it's not a problem, right? I find that it's hard to grow a big list unless I really start spreading out in different, like you say, counties or metros, because of the, trying to target that motivated seller, which makes it nice for me to be a real estate agent or broker as we call it, because if I miss, I can convert them. I'm an expert at converting them to a regular listing. When I say miss, I mean, it's not great for a wholesale deal, right? But since assignment fees are taxed as ordinary income, I don't care whether I get paid in an assignment fee or a commission. It's all the same to me, right?
Sure.
Unless you're the type of wholesaler that can get those, big spreads of, 25 or 30,000, which then that conversation doesn't work to have with a seller on that, converting that. More on that. If you guys are local here and want to know exactly how I do that, hit me up at julie@seattleiinvestorsclub.com or come see us on Tuesdays down in Burien at the Elliott Bay Brew House and Pub, where we have our weekly mastermind from 12 to 2 p.m. But we'll fill you guys in on that later. We'll keep cruising here. So how long have you been mailing the same lists? I guess I'll say. And are you every month pulling? Obviously, maybe you are pulling some new lists. Do you do driving for dollars? Tell us about your list criteria and all that.
Sure. So the list that we're doing with the ringless voicemail is we're scraping Zillow for pre-foreclosure information. So the thing is, like, I haven't done direct mail in probably a year, maybe a little bit longer. Even though I used to mail so much, it got to where it's such a wide funnel. And what I mean by that is we had 2.5 people on the phone full time to manage the calls for 70,000 letters. And so, but that created the same deal flow as 15,000 letters had 24 to 36 months earlier. So it just got to where it was less and less and less effective as more and more people began to mail the same list. But we tried everything. I mean, we ended up mailing everyone that had equity because it just got where we had to get the mail out the door, and it didn't matter because of the niche. Okay.
That's what happens to me, right? Yeah.
Right. But for those that have a limited budget, what I would say, like if your budget's $500 a month for mail, number one, I think you should be doing that in-house. But I think that you really look at creating the most niche list that you can, because you're only going to mail like maybe 1,000 or so, right? So maybe that's an auction list, like people that are going to foreclosure auction.
The problem in our state is we have a Washington State Distressed Homeowners Act where it's a big no-no for investors to deal directly with homeowners that are in occupied homes. If it's a rental, it's different. So investors in our state are not by law really allowed to target pre-foreclosures. So that's our crazy Washington State crap, right?
Well, yeah. And I've heard that state's a little peculiar, but that's interesting. So another one that we've had a lot of success with would be detainer warrants. So maybe it's a tired landlord, divorce. We've done arrest lists. We tried a medical malpractice list. That one didn't work out very well, but we just thought we'd try it. You
know what? Let me give you one. Maybe you know a way to get this, and I should be having this as a private conversation with Brad, but we're an open book and we share everything, so no secrets, guys. How about, have you ever figured out a way, or what do you think about this list, to pull people that are collecting unemployment?
That would be very interesting. I don't think I've ever heard of that.
Well, I think you're probably the man and more sleuth at that kind of stuff than me. So now that I gave you the idea, if you figure it out, will you tell me how to do it?
Yeah, I absolutely will. We'll do some ringless voicemail to those guys.
Yeah. Or just how do you get the list, right?
I don't know. I've got a list guy that's very, very good. And if anybody knows how to do it, he will. So I'll touch base with him a little bit later.
That sounds awesome. Yes, I have my way. I pull all those same lists myself. The landlords, then the divorces and the, probates and all that kind of stuff. So do you feel that is something like half your deal, since you are able to hit hard on the pre-foreclosures, is like half your deal pre-foreclosure stuff?
I wouldn't say half. I would say a significant minority are not necessarily pre-foreclosure, but are behind on payments. So our big five are behind on payments. They've inherited a house they don't want. It's a divorce situation. It's a tired landlord, or it's a health and safety issue. And I say safety because we've bought houses from people being abused. One of my favorite transactions was one where we bought the house without the son knowing that the mother was selling the house. The mother was being abused, and
Yeah.
we were able to kick him out, and that was a nice day. So, and that's one of the things as a real estate investor, you run into everything, all kinds of life situations. But those are our big five motivators that we see in a vast majority of our transactions.
Let me ask you a question about the pre-foreclosure stuff, because it does happen. No matter if you try to avoid them here, if you do any type of direct mail or marketing, you're going to get those calls, even if you're not trying to target them 100%, right? I find that the pre-foreclosure people are in absolute denial till the end, right? That you'd think they'd be motivated, right? But I find, at least out here, that they are somewhat savvy, and that they are very hard to get under contract. And you do not want to give them a contract unless you want them to sign it, right? Almost like you have to be in person. Otherwise, they shop it because there's so many people contacting them, right? I've even had it where they've taken my contract and then used that with their attorney to stop their foreclosure, right? And then they don't want to do the deal. It's a stall tactic because I gave them a contract, an offer, right? They didn't sign it and they used it to stop. Well, is there any insight? Does that ever happen to you? Do you feel like they drag your feet? Or maybe you're not the guy doing it at this point because you've got your whole team, but you hear what I'm saying? There seems to be an art to dealing with the pre-foreclosure people, at least out in our market.
Yeah, and I think that's true. So what I would say to that is I think a lot of it has to do with negotiation begins with the marketing piece. So if I'm doing direct mail, I'm going to get a lot different of a seller calling me than if I am doing AdWords and they've asked to be contacted. Okay, so like one is a push tactic and one is a pull tactic, right?
Super good point. Yes.
Yeah. So with that, the negotiation, in my opinion, with direct mail is kind of skewed in favor of the seller to begin with. So we really prefer more of a pull tactic. So that would be AdWords, and people are searching for you. We've done radio ads where people hear something and they're calling us to buy their property, versus a yellow letter where 30% of your calls are take me off your list. Another 40% are, well, I'll take $1 million for a property worth half that. Right. So, and it comes down to like social frame. So like the NLP idea of frame and all that. But one of the ways that we are able to get around that is we never give a price. So we never make offers. So we have a 5-question script that people, whenever they call in, they're going to run through these questions, and I'll kind of paraphrase them. So, number one is just, tell me about the house and what you have going on with it, which is actually 2 questions. Tell me about the house, or tell me about your situation. So wherever people gravitate is where they go. And it's meant to create a little bit of confusion and to get them talking first. All right. So question number 2 is, what are the repairs? Number 3 is, how soon do you want to close? Number 4 is there a mortgage? And if yes, are you a little bit? For some reason, we can ask someone, do you have a mortgage, or is it free and clear? And they'll say, well, I have a mortgage. Okay, what's the balance? And they tell us, oh, okay, are the payments current, or is it a little bit behind? Now, I don't know what it is about a little bit that makes people tell you that they're a little bit behind. But if for some reason it was like it doubled the response of a yes answer there, if we said a little bit behind versus just being behind. Okay. So next question is like, you're a little bit behind. Roughly how many months? And they'll be like, well, 18, just a little bit. But, so we get that out of the way. We tell them kind of what we do. And then we're asking them for their walkaway number. It's like, after the mortgage is taken care of, after we pay all your closing costs, all of this, what's your walkaway number? This is your check at closing. So we're never giving them a price. And so if they get us to a price that causes us to say, yes, we will go to that appointment, or yes, we're going to buy that house once we're there, then we have to hammer it down and say, look, if I can give you that, if I can get you $50,000 at closing, are you telling me that you would sell me the house today? And then they tell you yes. Well, you've never given them a price. And it becomes very, very difficult for them at that point to say, well, I need to think about it, or I want to shop the deal or whatever, because they've already told us that what their number is, that they would agree to, and that they would sell us a house today at that point. So, that's kind of how we get around that. But I don't think it's necessarily just the pre-foreclosure crowd. I mean, everybody wants the best price, and I want them to go for their best price, whether that's me or somebody else. But there have been a lot of times that with our negotiation, we've been able to buy houses cheaper, even with terms and subject to, than an all cash deal is. And that all comes down to being able to negotiate and build rapport and all that. So now I would say if people are being kind of squirrely and wanting to shop the deal, it's one of the main reasons why we never give a price and we don't leave offers with people.
Boom is all I can say. You guys can thank me later for introducing you to Brad, because that was badass. Brad, that was totally awesome. That was very clear, and you guys you just gave a head start to a lot of people who are listening to this today. So thank you. So. Awesome for that.
Hey guys, Joe here. I just want to take this super quick break from the action to let you know something that we have really cool to offer you guys. As you know, marketing is the lifeblood of our real estate business, and Julie and I spend a ton of money sending out postcards and letters to people all around the Seattle area. We've partnered up with YellowLetters.com to get you guys 10% off all of your marketing needs at Yellow Letters. All you have to do is go to YellowLetters.com, and when you check out, use the code Seattle Investors Club, and you'll get 10% off any of your marketing needs at YellowLetters.com. You can send postcards, letters, whatever it may be that YellowLetters.com has, so that you can keep your marketing engine running for a little less money. So go to YellowLetters.com, use the code Seattle Investors Club with no spaces, and get your marketing going today. All right, let's get back to the action.
What do you do when they say, well, you called me? Well, actually, in your case, they're not. They're calling you, right? Or I don't know, you're the one that wants to buy me a house. Give me a number. What's your response? To that objection?
Well, so sometimes people will say, well, you're the expert, so why don't you give me a price? And so they've given us a compliment and calling us an expert, so we have to thank them for that. So, well, thanks, Joe and Julie, for saying that I'm an expert. And as an expert, I would never give you a price on a house I hadn't seen. And the houses that I go and see are the houses that I feel that I can give them what they want. So what are you hoping to walk away with?
Boom. The old redirect. I love it. This is some good stuff today, guys. There's nobody else on our podcast that have given you this specific information. So high five to Brad today. Good stuff. I love it. That's it right there. We can like be done now because that was so awesome. I'm just teasing. That was totally rad. So let's talk about subject two. I know you like to do those. I think that a lot of us listening absolutely know what subject to investing is and how powerful and stuff it can be. But there's also some trepidation with doing subject to. I mean, I think subject to is awesome if you're going to flip it or whatever, right? Because you can get it all paid off quickly and all that stuff. But what do you understand what I'm saying when I feel like people have hesitation that subject to is a big legal tangle and lots of risks, and you got to have your documents be perfect? And what do you say about that kind of comment that I've just made?
Yeah. So number one, we're equity buyers. So, we're creating equity in our transactions, but we're buying equity day one. So to put numbers to a transaction, I mean, let's say the house is worth $500,000 and we're paying $350 for it, and we're paying $350 subject to. Well, if there's some kind of an issue where the loan gets called for some reason, which I've never had happen, but I do understand that it happens at times. So it's like lightning does strike sometimes. Like, that's okay. So we can bring in a hard money lender or private lender or get bank financing or whatever we need to do to extinguish that debt. So it's not a situation in which I'm really concerned.
Because you're prepared to take it out, no problem, if needed.
Well, and that's, but especially, and I'm in a deed of trust state, and most of my transactions are in deed of trust states. And for those of you who don't know, that means that it's a non-judicial foreclosure state. So in Texas and Tennessee and Georgia and a lot of the states that I'm in, you can foreclose in many cases as fast or faster than you can evict a tenant. So then we're really kind of racing against the clock. If you're in a mortgage state, and you're buying equity, you're buying real equity day one. I can't conceive of a notion where in Florida, a bank could foreclose on you faster than you could sell and pay the line off. But another big part of this is being 100% upfront with our sellers. We want people to understand, and there's a ton of documentation and disclaimers and initial here about, this loan could be called and the loan is remaining on your credit report and it could impact your ability to obtain credit in the future. We want to be 100% upfront with these things.
And are the sellers that are willing to do that, it's kind of like, they're already calling you for a reason. It doesn't seem to faze them, or do you ever find that it makes them pause when you put that straight front and center on them?
Well, it's both. It's both. So it's a couple of things there. So if someone's behind on payments, it's to their benefit that we take it subject to. It's not to their benefit to pay off a loan that's 6 months behind. It's to the seller's benefit to catch up that loan at closing and continue to make those payments on time until that debt is extinguished. That's going to help their credit tremendously. But the bigger part of this is when in the negotiation to switch from price to terms. So, and here's a big thing, guys, like you have to negotiate price first and then switch to terms. So kind of how that works is, in the scenario we gave earlier, like, you're going to sell me the house today if we give you this money. And they say yes. And it's just okay, I can give you that $50,000 at closing. If we can do it another way, we're going to have to do it like this. So then we're kind of like dangling the carrot in front of the donkey. Like, okay, if you're $50,000, here's how I can get you that $50,000. So it's to their benefit because I'm a firm believer that people chase what moves away from them. And so if I'm not coming overbearing trying to take that deal, then I'm going to have an easier time negotiating terms versus if I'm really I spend too long on a rapport. So I know people that spend 2 hours talking about their dog and their hamster and football team and all that. I think it's a total waste of time. But they're spending too much time on rapport, or they're not clear that their objective is to buy the house. So, we're in and out in 45 minutes in almost every circumstance, right? So if we can switch from price to terms effectively and do it in a way that they think that they're winning because by agreeing to our terms, they're getting their price, then we're going to be a lot more efficient in buying with terms.
Awesome stuff. Loving it. So on the subject to houses, what's your exit strategy on those? Do you ever hold them, or you just refi them out, or what do? You kind of burr them and then refinance them out?
I'm not a big fan of burr. So okay. I saw a lot of people really get hammered with that in like 9, 10, and 11. So it's like everybody was refinancing out equity. It was like quote unquote tax free, but then rents kind of dropped. Right. Equity went straight to hell.
You don't want to over leverage, right?
Yeah, correct. So they went from being like at 90 or 95% LTV to like 120% LTV.
Right.
And that's tough for people. So
what is your favorite strategy?
My favorite strategy is to buy and then owner finance. So with that, we're creating wrap notes, we're creating future cash flow, and we have multiple profit centers at that point. For a long time, the market had been so hot that I retailed out of almost everything. So I started off creating notes, and then I did some wholesale deals, which I really didn't like because it's like, well, I already have this really big equity position and I have the ability to take it retail. So I was just taking everything retail.
Right.
And I did a couple little land developments. I really didn't enjoy that. I hate the construction part of it. So I'm not going to do like big rehabs anymore. But basically I was telling Joe earlier.
You know what? That's how people, the Peter principle, you're good at what you're good at as an investor. And then you think, oh, big money's in development. You know right. How many people get taken down by that because they think they're a good investor. So they start becoming a developer, and it's total spanking of a different way. Right. And you lose everything. And guess what? You go back to doing the bread and butter that, slow and steady wins the race. Right. I think going to switch to the development is where the greed starts taking over.
Well, I really like the idea of impacting communities by building development. But the problem that I had with it is politics, or like I say, politricks, because even at the local level, you can have someone that just doesn't like a project and arbitrarily say, well, we're not going to approve this, even though you've gone through everything and it's to code. So that was my problem with it. But whereas if we have a house where the painter doesn't show up, it's like, well, no big deal. Like we'll go get another
right.
painter.
Can you give us an example of of how, a deal, take us through like a full deal. So you get a lead and you switch them to, does that mean when you're owner financing them, you're doing a wrap, or what are you doing? Is that a subject to house and then you wrap it, or?
Yeah. So let's go through a transaction. This was our last transaction that we bought. So I'm going to get my pad and paper just so I can keep the numbers straight. So there was $240,000 owed at 3.99% fixed. Okay. So we bought it subject to 240 and gave the seller 10,000 at closing. Okay. So I'm in the deal at $250,000. So we're currently marketing the house with owner financing at 340,000. So we'll get probably 3,000 down. And so we had $10,000 in down payment to our seller or their walkaway money. So we'll have 20,000 net in the deal in cash. Okay.
Did you have to improve the house to get that 340?
I'm sorry?
Did you have to make improvements to the house to get to the 340?
No. Whenever we owner finance, I mean, if the yard needs to be cut, somebody better go cut the grass. So it's not going to be us. To the point, this is kind of a funny story. I bought a house one time that had such a bad roof leak that in the marketing, we told the people that were looking to buy it with owner financing that if it's raining that day, you need to take your umbrella in the house. And we sold it with owner financing. But so back to my deal. So we're selling it for $340 with 30 down. So we'll have a $310,000 wrap mortgage. That's a second at 7.99%. Okay. And that's a 30-year loan. And we do fully amortized loans. We don't do balloons. We don't do prepayment penalties. Okay. So 310 wrapped around 240. So I've got 70,000 in note equity on that deal. So I got $10,000 in down payment. I'm sorry, $20,000 in down payment net. I got a $70,000 note that will yield, I don't know, probably on that deal somewhere around $1,000 a month in interest net. Okay. So that's kind of like an average deal. So your profit centers here are your net down payment, which is $20,000, your cash flow monthly, which would be roughly $1,000. I haven't run the math. This is just top of mind. Your $70,000 note that's actually going to appreciate over time. And then you have your difference in the pay down on the underlying. So that the $310,000 wrap is going to pay down slower than the $240,000 underlying. Okay.
Right.
So that's kind of the profit centers on an average subject to wrap that we do.
Let me ask you a detailed question, because I don't do many wraps at all myself and subject twos. When you put that wrap on the 310 in second position, then the first position is going to get notified of that, right? I mean, they will do public record or
correct. Yes, it's definitely public record.
Right. So if you're not going to alert them, they will likely be alerted through insurance or through, some sort of method that's going to notify them. I am assuming that breaks the, the rules on the underlying mortgage, but nobody ever says anything. And then you're just prepared to do something about it if it does, or what?
So it sounds like you're kind of asking about the due on sale clause.
Yes,
so, yeah, we can totally go over that. So for those of you who don't know, the due on sale clause is a provision in almost every traditional mortgage loan today that says that in the event of any transfer of title or equitable interest in the property, that the lien holder has the ability, they have the right, but not the obligation to call that loan due. So the bank could, in the circumstance of this, call the loan due. So we'll talk about a few circumstances in which is considered normal, but the loan is never called. So let's say there's Bill and Sally. They get married. They buy a house, and then they get divorced. And Sally gets the house. Bill and Sally are on the mortgage, and then there's a transfer of title from Bill to Sally. That doesn't trigger due on sale. Same thing with inheritance. Doesn't trigger due on sale. Most due on sale clauses actually have the provision in them that if the house is vacant for more than 30 days, then they can call the loan. So it's like if you're old and wealthy and you want to do a world cruise, you better have somebody in the house. If there's a lease option on the house, in most cases, the due on sale clause can be called. So again, this is not like legal advice or whatever, but I encourage everyone that if you have a mortgage and you have a copy of the note, go and take a look at it, because you'll see the due on sale provision and all the things that's covered. And I thought it was so funny because like during the bust of 08 and 09, you had real estate agents all the time doing lease options. Well, it defaulted the same clause that a subject to transaction does, right? But I've never had a personal loan get called. I had a friend get one called. He sold the house. It had equity position. It wasn't a big deal. It's a mitigated risk. So it is a risk, but I think it's a relatively low risk, and it's one that we are 100%.
But in this case, with the wrap, you've already sold it to somebody else, so you're not in control of selling the house, right?
So and that's a good point. So in this position, as the lien holder, what we could do is we could bring in a private money person to pay off the underlying, or we could sell our note to completely pay off that underlying.
Okay, gotcha. Right. Always making sure that if you're going to dabble in this sort of thing, that you guys have those relationships and abilities to, get those private money loans or take out, you got to be able to qualify or have relationships that are going to, allow you to have that backup strategy. Right now, what's going on in our market is that we had let's say a 10% drop in our market the last half of 2018.
I heard.
Yeah. And a lot of people got spanked around pretty hard, even a lot of big players too. And, we have a lot of lending buddies here, locally here, either private money or hard money and stuff like that. And, the majority of these people, I would say, or I don't want to say a majority because I can't say it for sure because I'm not taking those calls, but a lot of people have no plan B exit. They just simply got spanked because they can't qualify to put take out loan, to take out that hard money loan that, that they took out to flip that house or whatever. It's crazy how many people are not taught the downside as the first thing. Everybody's looking at, the upside. They should be taught the downside first. And that if they're not in a position to handle the downside, they shouldn't get started, or they should start in a different way. I mean, it's insane to me.
Well, everything works in an appreciating market, especially a heavily appreciating market. And there's a reason why that the Titanic should have had more lifeboats.
Right. Exactly. Awesome stuff. All good stuff, Brad. We like Brad. Maybe we'll have to twist your arm and get you out here to the Pacific Northwest. Have you ever been out this way?
The closest I've been is like Sonoma, California. So still quite a ways away, but I hear it's beautiful country. I'd love to come out.
Yes, we'd love to have you. I'm going to talk to you separately about that. So let's go back and say, how have you had to pivot your business over the years? Have you, do you feel like something works for about a year and then you have to kind of do a little pivot, or what's your pivot strategy or feedback on that?
That's a really good question. I would say that for me, the pivoting has centered more around the marketing and what has been effective and then turns like not as effective. So, I mean, direct mail still works, radio still works, bandit signs still work. I would say not as effectively as all of those three things used to. But I'm a firm believer that you can drop pamphlets from the sky saying, I'll buy your house, and you're going to buy houses if you drop enough pamphlets. So, anything works some of the time. And that's one of my big mottos for our business. So, but my main pivot points have always been around the marketing aspect. And we're all the time, but I'm not really good at kind of like halfway doing something. So like I'll go out and do way more marketing than I should and just break every system that we have. And, that's happened at times, or oftentimes I would say. So there's always times
that's like Joe, right? Joe, don't you identify that? Weren't we talking about that with you and like even the fitness stuff, that you'll just go and you'll push it until you break your body, or something like that?
Yep. Ultimate. Okay. Focus. Yep.
Absolutely. Awesome stuff. Well, let me ask you, I read something, I think it was on that House Flipping HQ. So I'm going to steal this question because I thought it was interesting. It asks you, what are the key questions that shift your mindset? I don't know when you did that podcast, but I happened to see it and I learned a little bit about you from there. So I've completely, just guys, for letting you know, I stole that out off of House Flipping HQ, which is another podcast, that question.
The big thing for me when it comes to mindset is making sure that I live from an abundance mentality. And that's kind of what I was alluding to there is it's tough to be abundant and have scarcity in the same place. And one will absolutely destroy the other, whichever one is more the focus, right? So one of my main things is I get up every morning. I have a list of things that I'm thankful for. I go through each one and I add to the list every day. And it's just really amazing all the things that we have in this life, especially being in America. And we're very, very blessed. But I'm blessed to have a great family, healthy family, good health, great business, good people that I work with. I can honestly say I don't work with anybody that I wouldn't go hang out with weekends, which is a great thing. So, but for me, living from the point of gratitude is super, super important. And I missed that boat for a long, long time because I was always scared. It's like, and entrepreneurship is scary. There's more going on with your success in between years than the external components of what's happening. So everything is really how you relate to it and how you react versus whatever's happening. So you can, I think relationships are actually like a great parallel to the business world. So it's like you can be in a relationship and the relationship goes south and just be decimated by it. Or you can look at that and be sort of thankful, like, hey, I had some great times with this person and it was a positive thing for a long time. And I learned a lot about what I want the next person versus being like, oh, poor, pitiful me. I'm never going to find anybody, whatever. It's like same event, different outlook. So, having the right outlook is super important because, living from lack in the business world will destroy you.
Do you have any abundance and mentality podcasts that you listen to or any resources that you enjoy in regards to keeping that forefront in your mind, or are you just that guy?
Well, no, I'm not that guy. It's a constant struggle for me. So I'm a big fan of Glenn Harrold. He's a British hypnotherapist, and he has some stuff on iTunes that some of it's like hypnotherapy tracks that you really shouldn't listen to when you're driving, and I don't because it's like doesn't sound like the best thing for me. But he has some other tracks that are like really upbeat and it's kind of like priming yourself to be positive. So, I can have some bad news come in and run that track for 20 minutes and it's like, I'm back, and that kind of stuff. Some people like Grant Cardone, I think 10X and Be Obsessed or Be Average. Those audiobooks are really good. There's some really great podcasts on London Real, which is with Brian Rose, which I really like. But, everybody's going to kind of resonate with whatever they resonate with. So, that's just what I feel works for me.
Awesome. I'll give you a tip because I know you have young kids, but I learned from one of our local investors here and one of our local, I would say, mentors here in our Seattle area. His name's Thatch Wynn. I think you all know who I'm talking about if you're here in the Pacific Northwest. Surprised he hasn't made it out to your neck of the woods yet. I'm sure he will. He's looking to conquer the world, and who knows, he might. But he has this thing called AID, which is about laws of attraction and intention. And I used to do that with my kids to get their mindset right. They're only 10 years old, right? But I'm that crazy entrepreneur, so I'm like turning my kids into the entrepreneur by the, right now, time to start. But it is amazing. We used to do this every morning, and I'd ask them what they appreciate. What do they appreciate today? What's their intention today? And then they could, essentially ask anything they wanted. And, it was called, attention. It was called appreciation, intention, and delegation. AID is what he was calling it. But some of the responses that I would get out of my kids were absolutely phenomenal. When you ask them, I can't wait for your kids to get old enough for you to ask them, what do you appreciate today? And listen to what they say. It is so fun because it's a different perspective, right? So simple, so honest, and very enlightening. So
that is so good. My little girl, she's 3.5, and I'm really, really, I guess, hell-bent on kind of dropping the right programming into her. And so we have our affirmations. And so I thought about this big, long list of affirmations for her. And the three that I felt really, really good about, and she says them every night, is I'm loved, I'm strong, I'm special. And so we do that at the end of every night. And so sometimes she'll just be walking around the house saying, I'm loved, I'm strong, I'm special. I'm loved, I'm strong, I'm special. And I'm like, gosh, if I can just keep her believing that,
Right.
Then I think everything else is just kind of secondary.
Awesome stuff, man. Well, here's a big question for you. We're wrapping up here. We're getting towards the end, but this has been really fun. So I'm going to keep you as long as I can. But at this point, like, what's your wealth building plan? Because or how do you handle your tax problem if you have one, right? Because I think investors, they jump into this and they start making money and they realize that, holy crap, I am paying way too much in tax if I'm flipping or wholesaling or whatever. And I think that probably a lot of the stuff you're doing, is it end up being ordinary income, or is it long-term, like capital gains type income? And what do you do, or do you have any problems there, or solutions or strategies? Or
Yeah, I have some thoughts there. So it's a couple of different things. So number one, it's one of the reasons why I don't like to flip or retail out of any more than I have to. So kind of our intention right now is to retail out of whatever you need to for cash needs, but we're playing the long game. So the long game for us is creating note equity. And the more note equity that you can create, number one, you're shifting it, and I'm not a CPA, but you're shifting it from a short-term income, which is ordinary income, taxed at ordinary rate, to a long-term capital asset. Another thing that I would recommend you guys, the listeners do, is really take a look at inherited Roths. So Roth accounts are not taxed, but if you inherit one, then you can grow that Roth account, and it's the profits aren't taxed. So in theory, if you had a Roth, you could go and buy a house in a Roth. You can do other investments in the Roth, rentals, notes, whatever. And those are just huge, huge tax savings because there is no tax. So
that is my number one favorite subject right now.
Yeah. Yeah. So my goal is, and I have a friend of mine that has about $2 million in note equity right now. He has no taxable income, but he has about $2 million in note equity that throws off, I don't know, like a 12 or 13% yield. So
Yep.
I'm doing fine, and he just goes on cruises all the time. So
I have so many great ideas to how to use your Roth for that kind of lending and wealth building. Do you know who Jeff Watson is?
I don't.
Look him up. Look up WatsonInvested.com when you get a chance.
Okay.
And check out who he is. But we just had him out on our quarterly event here at Seattle Investors Club. He's a national recognized authority, not only on legal wholesaling, but also he's an expert on, building wealth with, tax free through, using a self-directed IRA or especially Roth. And we just had him out, and he gave us some badass strategies for using your Roth as far as, what you and I are talking about right now. In fact, for all you guys who are listening, if you want to learn more from me, and especially if you're a real estate agent or you're thinking about getting your real estate license, I have some big news to share with you. Too much to share right here on this podcast at this moment. But please come see me on any Tuesday from 12 to 2 in Burien at the, what is it called? The Elliott Bay Brew House and Pub. Every Tuesday we're there with a small group coaching mastermind. And I have some ninja stuff that I am rolling out that I want to share with my friends. If you can't make it to that for some reason, hit me up at julie@seattleinvestorsclub.com and just put in the subject line, I'm in, tell me more. And I will contact you and tell you what I'm up to and how you can be a part of it. But exciting stuff rolling down the pipe here for me. Specifically, part of it having a component to do with these Roths and self-directed IRA investing. So that, I think, Brad, we want to have you back on another time. Maybe we can talk more about that on another time separately. There's probably all kinds of topics we can dive down on with you. I love your style and your straightforwardness. And we've never met in person, but I feel like I know you already. And
we're kindred souls, and my wife, I'm sure, would thank you for this because it got an hour of real estate talk out of me without her having to listen to it. She for like 14 years now. We've been married for almost 10, but even my dating days, it's like, I'm going to buy some houses,
Yeah, I hear that, man. So we're going to have to find a way to bring you out here to Seattle and wine and dine you maybe for a weekend, bring your whole family.
I'm sure the family would love it. I've always wanted to go to see the first Starbucks. So
There you
I
go.
drink way too much Starbucks, and I kind of wonder if the people in Seattle are kind of like anti-Starbucks because it's like it's not original anymore or whatever. But
Well, we have a lot of other great coffee besides Starbucks. There's no doubt about that. But Starbucks is a homegrown company, so of course we love Starbucks. But we can give you a tasting tour of some other great coffee as well.
well, that'll work. I'm an equal opportunity coffee drinker.
Awesome stuff. Well, geez, I feel like I could go on forever, but we're at a good breaking point. So I think I'm going to wrap it up here. I guess I'll ask you, are you mainly, do you ever invest in are you interested in investing in multifamily or self-storage or other asset classes that are, don't require you or maybe they do require your expertise, but any type of syndications, or are you just crushing it so big with your business plan that you use all your funds to grow your wealth within your own world?
Excuse me. I don't really know that world. I'm certain I would look at whatever, and I have friends that I know would look at whatever. For me, I would say more likely than not, it'd be tough to get the yield outside of my business, and I'm getting inside the business.
Right.
But I'm happy to look at whatever.
Awesome stuff. All right, guys. I hope you guys are as excited as I am to be introduced to Brad. So Brad, if people want to check out all the goodness about your podcasts and your blogs and more about you, where can they find that information?
Yeah, for those inclined, it's bradsmotherman.com, investor creator with Brad Smotherman on iTunes and Stitcher and all those other places. And if you really feel inclined, I'm happy to have you a friend on Facebook. So I get multiple requests a day from new real estate friends across the country, and happy to add you there.
Awesome stuff, guys. Well, hopefully we'll all get a chance to meet you in person. But other than that, enjoy the rest of your week. And thank you again for jumping on the nuts and bolts of real estate investing with us today.
All right, Julie, Joe, appreciate it. Had a great time.
Joe, where can they find the details of this podcast?
Yeah, guys, all the show notes are at seattleinvestorsclub.com/71. That's seattleinvestorsclub.com/71. And if you like this podcast, we'd love it if you give us a review. And lastly, remember you can subscribe for free on any of the podcast sources.
All right, guys, come see us on a Tuesday, 12 to 2 p.m. Hope to see you there. We can do a deep dive about you as well. Over and out. Later.
Thanks for listening to the Seattle Investors Club podcast. If you have questions that you'd like to have answered on the show, shoot us an email at info@seattleinvestorsclub.com. Now go out, take that action, and build that real estate business. Thanks for listening.